This fund will never recover its NAV. This article was written by Kevin Shan. Summary: the Roundhill S&P 500 Zero DTE Covered Call Strategy ETF offers 20% plus yields and weekly payouts, but investors need to be mindful about NAV erosion and potential tax implications. XDTE's synthetic covered call strategy is subject to mark-to-market rules that prevent XDTE from recovering its NAV over the long run. These rules also subject XDTE to potential unintended tax consequences that investors need to be aware of and plan around. Overall, positive total returns and large payouts give investors more control over their finances that could be worth more depending on their personal situation. I rate XDTE a buy so long as it maintains total returns closely correlated to the S&P 500 and its AUM. With the S&P 500's increased volatility due to various factors such as China's AI developments and Trump's economic policies, covered call funds are anticipated to generate larger premiums from their option strategies. These increased distributions, along with a fall in the price of the fund, make many covered call funds an attractive buy right now for the potential to secure a high yield on cost. One such fund is the Roundhill S&P 500 Zero DTE Covered Call Strategy ETF, XDTE. XDTE yields 26.27% at its current price and is a great addition to many income investors' portfolios. Before buying, however, investors do need to understand the mechanics behind XDTE's large distributions. Roundhill's fund is unable to recover its NAV over the long term due to mark-to-market rules on Section 1256 contracts. That said, NAV erosion is a small issue, so long as XDTE meets the requirements of sustaining its AUM and maintaining positive long-term total returns. The more significant problem is that XDTE investors could face unintended tax consequences that would reduce returns significantly. These tax consequences can be avoided by holding XDTE in tax-sheltered accounts, and could also be a hit worth taking depending on how much an individual places on weekly distributions and cash flow. I rate XDTE a buy due to the flexibility it offers from its large distributions, but if 20% plus yields are unnecessary and you're investing in a taxable account, funds like SPY, T-SPY, TT, and GPX can be preferable. XDT faces permanent NAV erosion. As suggested by the fund's name, XDT is an ETF that sells 0 days to expiry, 0 DTE, call options on the S&P 500 with the goal of generating income on a weekly basis. Key things to note is that XDTE runs a synthetic covered call strategy and trades index options that are classified as 1256 contracts. These options have multiple benefits, like cash settlement and European-style exercise, where contracts cannot be exercised until the expiry date. For this article, I'm going to highlight the taxation rules on 1256 contracts. Many investors may be familiar with the benefit that 1256 contracts offer, where option premiums are taxed as 60% long-term and 40% short-term capital gains. What investors may be less aware of, however, is the mark-to-market rule, where a profit or loss on the fair market value of the contract will be calculated regardless of whether the contracts were actually sold. This is important with consideration to XDTE's strategy, because the underlying asset they use to cover their call options are in the money, ITM, SPX index options. Due to the classification of SPX index options as 1256 contracts, XDTE faces the mark-to-market rule, and as a regulated investment company, RIC, must distribute their gains or otherwise face tax consequences within the ETF. The result is that XDTE will never recover its NAV, because its long-term gains in the underlying are always realized and distributed by the end of each year. This is why XDTE had abnormally large distributions in December 2024, and why its share price has been continuously falling despite an overall gain in the S&P 500. Over time, XDTE will offer smaller and smaller distributions and likely reverse split as NAV per share falls, mitigating the NAV erosion issue. Despite these NAV erosion issues, I am still bullish on XDTE as an income investment. Readers who have read my articles on XDTE's sister fund, QDTE, will know that I view NAV erosion as a non-problem in high-yield funds when certain conditions are met. These conditions are long-term positive total returns and AUM sustenance. XDTE has met both of these requirements. Although XDTE has only been around for a year, Its performance allows us to reasonably expect that it will continue tracking the S&P 500 with minimal upside loss. Selling covered calls as a strategy is one that sacrifices potential upside in the underlying asset in return for income, as your gains are capped by the strike prices you set. What XDTE has demonstrated in the past year is that its management team has managed to capture the majority of the S&P 500's upsides, and sometimes more, even after the 0.95% management fee, but at the cost of less downside protection. But with how similarly XDTE tracks the S&P 500 and how the S&P 500 tends to go up over the long run, XDTE will likely have positive long-term total returns, barring any disastrous change in the management team or options market. The second requirement of AUM is also filled, as XDTE has garnered over $400 million in AUM since its inception 1 year ago, and the fund has not stagnated to a point of decline yet. What these two requirements do for XDTE investors is that it allows them to buy XDE and reinvest a portion of its distributions to mitigate NAV erosion issues. For example, if you put $100 into XDTE at its inception and reinvested 50% of your distributions, your original investment of $99,990.28 would be worth $100,960 today, and you would have collected about 12.7 KRs in distributions for a yield on cost of 12.74%. If you only reinvested 25% of your distributions, your $99,900.28 initial value would still be worth $94,889.16 today, and you would have collected around 18.5 Ks in distributions for a yield on cost of 18.54%. Both studies were done assuming you reinvested distributions on each distribution's pay date at XDTE's closing price. Broker commissions and fees were not accounted for, but share acquisitions were rounded down to the nearest whole share. Of course, in a falling market like what we're seeing recently, reinvestment of distributions is unlikely to outpace the rate that the market drops. You will have to accept some volatility in your portfolio. The beauty of having this tremendous yield from XDTE, however, is that cash flow is flexible. You don't have to reinvest 25% or 50% of your distribution back into XDTE all the time. If you want to prepare for unexpected expenses, for example, you could easily put a chunk of your distributions into a savings account or T-bills. You could also put your distributions toward other investments like high-quality dividend growth stocks to secure your income for the future. The point is that you have choices with XDE. Depending on your personal finance situation, XDTE becomes more or less valuable. XDTE tax consequences. Although I rate XDTE a buy, there are very real situations where XDTE's tax consequences are significant. How significant? Well, let's consider a scenario where you make above 60K and less than 100K or 100K to 200K as a married couple filing jointly. Based on long-term capital gains and ordinary income tax rates for 2024, you'll be paying 15% on long-term capital gains and 22% on your short-term gains. If you had bought 2K shares of XDTE at its inception, your $20,407.32 in payouts would have been $19,142.30 after taxes. Now let's compare this to the Goldman Sachs S&P 500 Core Premium Income ETF, X. An S&P 500 covered call fund that consistently yields about 8.5%. Considering GPX's distributions in the same time frame as XDTE, 2K shares of GPIX would have resulted in $6,087.80 in total distributions and $5,835.00 after taxes. GPX lost only about 4.15% to taxes, while XDTE lost 6.24%. The real consequence can be seen in total returns. Buying 2K shares of XDTE on March 7th, 2024 would have created an initial position worth $104,920. At the end of the year on December 31st, 2024, this position is worth $100,320. With GPIX, purchasing 2K shares would have started you off with $92,460 and ended with $98,900. When you factor in distributions after taxes, GPIX would have generated a total return of 13.28% and XDTE at 13.86%. According to Seeking Alpha, total returns for the two funds in this time period before taxes should have been 14.04% for GPIX and 16.39% for XDTE. Taxes had essentially eaten away at 2.53% of your total returns on XDTE in the span of 10 months. This inefficiency will only compound over time. As always, I just recommended to seek a professional tax advisor for your personal situation. There are numerous considerations like state tax and offsetting capital gains with losses from other assets that have not been factored in this experiment. This discussion is here to make you aware of potential tax implications from XDT for figure out the best approach with this fund for your personal situation. GPIX 2024 Tax Reporting Information, XDE 2024 Tax Reporting Information, XDTE by under right circumstances. For many investors, taxes can generally be avoided by investing XDE under tax-sheltered accounts. Depending on your personal situation, these tax consequences can also be minimal relative to the value that XDE provides through its large weekly distributions. As a fund, it has been shown to track the S&P 500 very closely, with a stronger ability to capture upside at the cost of less downside protection relative to other S&P 500 covered call funds. With some dividend reinvestment, you can generate yield on costs of 10 to 20% consistently while preserving your original capital. There will be inevitable volatility, but so long as the fund captures positive total returns over the long run and maintains its AUM, XDTE is a buy for income investors who benefit more from the cash flow flexibility it provides than any tax consequences they may suffer. This article was written by Kevin Shan,